Don't put all your eggs in one basket. That's the basic premise behind diversification. It's a popular investment strategy that tries to mitigate losses by spreading an investor's risk across multiple investments and different vehicles. Here's how it works. Investors and financial professionals diversify their holdings by investing money in a variety of different investments. This gives them a cushion against risk. The idea behind this is that the positive gains generated by one investment effectively balance out any losses generated by another investment. You can do this by diversifying your stock holdings to companies in different sectors. You can further diversify your investment holdings and neutralize stock market risk by investing in fixed income securities, real estate, and cash. Followers of the most successful investor of all time, Warren Buffett, may already know his thoughts on diversification, so those of you who do not, his views are quite simple. He doesn't believe in it. Of course, all of the textbooks and all of the advisors will tell you that he's wrong. Indeed, his mentor, Benjamin Graham, will tell you the same thing. However, maybe Buffett has a point. Maybe diversification is at least overrated. Think about it. Do you have the time to keep on top of dozens of companies in your portfolio? The average person simply cannot pay enough attention to a broad spectrum of stocks in a variety of industries and/or asset classes. It's unwise to spread one's funds over too many different securities, said Bernard Baruch. Time and energy are required to keep abreast of the forces that may change the value of a security. While one can know all there is to know about a few issues, one cannot possibly know all one needs to know about a great many issues. There's no doubt that it pays to be diversified. Doing so helps manage risk and mitigate losses. As one sector or investment class goes down, these losses should be neutralized by the gains in another. But, as Warren Buffett points out in his famous quote, you won't benefit from this strategy, or any other one for that matter, if you don't know what you're doing. Knowledge is power, after all. Doing your homework before you begin actively investing will help you realize the returns you seek. The more stocks you own, the slower you may be to react and take selling action to raise sufficient cash when the next serious bear market begins, wrote William J. O'Neill in his classic book, How to Make Money in Stocks. However, if the world's richest investor doesn't diversify, why should you? Sure, it may reduce risk, but the risk is only one side of the equation, reward is the other, and diversification, whilst it undoubtedly reduces risk and volatility within a portfolio, can also reduce your reward. This is especially obvious when investing in shares or funds. The long-term performance of shares is generally accepted to beat other asset classes. This is open to some debate, but is generally accepted as fact in the investment community. Why then would you invest in assets which are not generally viewed as delivering the same or better level of return? Surely that's counterintuitive. To an extent, it is. This is because many major asset classes are closely correlated since they rely upon the performance of the economy. Shares, higher yield corporate bonds, and property are examples of assets that tend to perform better during periods of economic growth and worse during economic downturns. If you spread yourself too thin, you'll compromise your results and your likelihood of beating the market. Many financial writers preach the value of index investing. Just buy the whole market and be happy with being average. That's fine if you're aiming for average returns and don't want to bother trying to beat the market. It's unlikely, though, that you'll be able to accumulate serious wealth by utilizing that strategy. No hospital wings or college dormitories have ever been named by an indexer, said James Oakslager, founder of Oak Associates. They've been named by people who invested in one or two stocks and rode them for a period of time. An investor who studies trends and has a keen understanding of how different companies and industries react to various market trends profits much more by using that knowledge to their advantage rather than passively investing across a wide range of companies and sectors. This kind of investor can go long on a company or sector when market conditions support a price increase and exit their long position by going short when indicators project a fall. By doing so, the investor can profit in either scenario. These profits, therefore, are not offset by losses in unrelated industries. The beauty of the 75-25 portfolio is that it is incredibly simple and effective to implement, and crucially, it offers the opportunity to manage risk whilst generating a generous reward. With private investors seemingly fed up with jargon and believing they lack the time to manage their own financial affairs, surely the 75-25 portfolio is a more effective idea than an asset allocation model which delivers low-calorie rewards, takes up too much time, and serves only to spread risk among highly correlated asset classes. The problem with diversification, in Buffett's view, and investors just like him, is although the risk is managed and mitigated by sector gains offsetting sector losses, the opposite is also true. Sector losses offset sector gains and reduce returns. This is something he can speak to with very good authority. That's because Buffett amassed a fortune by acquiring incalculable knowledge about all things finance and about specific companies and industries. He took that knowledge and handpicked his investments. Just take a look at Berkshire Hathaway, BRKA, BRKB. The company is invested in many industries, including railways, banks, and financial companies, consumer goods, retail, food and beverages, and technology. Warren Buffett said in a CNBC interview in early 2018, "Just looking at price isn't investing. There's a strong difference between value and actual price. That's what the best investors understand, and that's on what they capitalize. Due diligence is the DNA of your investment and what's keeping you from selling in hard times. Take the time to do it, and don't invest in stock until you've put the effort and the energy into it." The determining trait of the enterprising investor is his willingness to devote time and care to the selection of securities that are both sound and more attractive than the average. Buffett's mentor Benjamin Graham wrote in his seminal tome, The Intelligent Investor, "Over many decades, an enterprising investor of this sort could expect a worthwhile reward for his extra skill and effort in the form of a better average return than that realized by the passive investor." The biggest argument for diversification is protection from risk. By buying a multitude of stocks, it's true that you're lowering the risk that any one stock would fall and wipe out a big chunk of your portfolio, but you're still not protected from overall market risk when the whole market tumbles. One strategy is to buy a select few stocks in correlated sectors. For instance, you can buy a technology stock and balance that with some consumer staples companies to counterbalance a higher risk sector with a more defensive one. Stocks with lower betas tend to fall less than the overall market during a downturn. Lastly, investors that seek to diversify often fall into the mutual fund trap, generating mediocre returns often offset by inflation rates. Mutual funds are index funds that are actively run by managers. Not only do these investment vehicles often buy poor companies, but they also charge high fees, averaging 2.1% of the principal invested in Canada. According to an article from the Financial Post, the primary focus of mutual funds is not to make their clients money, but to charge them more fees. They achieve this by buying more assets, resulting in more diversification. The returns of these funds are often poor and even underperform the ones of low-cost index funds. In the last 15 years in the United States, 92% of mutual funds underperformed market returns, often classified as average. In Canada, CIBC's balanced fund generated a mediocre 4.8% yearly return in the last 10 years. Investors are much better if they did their own research and concentrated their funds in companies they understood while benefiting from commission-free platforms available nowadays. Therefore, individuals should pass on the diversification strategy due to the poor quality of many of the diversification instruments, such as mutual funds, whose main goal is not helping their client retire. Instead, investors should concentrate their funds on businesses they love and understand and thoroughly analyzed. Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Don't forget to subscribe to our YouTube channel, hit the bell icon for more updates and notifications. Stay safe, and we'll be back soon with another video.